Warren, the local market and local funds have not performed in the last 5 odd years. That means investors are not achieving their projected returns, and obviously one's getting despondent. Is it not a lot easier to just look at which funds or which sectors have performed the last 3, 6, 12 months, and just take your money and go into those sectors? Is that not a simpler, easier solution for this sideward movements we are seeing in the funds these days?
Well, Theo, tough question to start the conversation. It's extremely frustrating for investors, but I think the important point here is to understand that what works now, the thing that works now, is possibly the most dangerous kind of investment there is, because whatever works now is likely not to be working in the future. And it's a mistake that we've seen investors make over many decades now, where they'll buy gold because gold's the current best performer, or in the South African context, probably money market unit trusts, income unit trusts have been the best performer over 5 years. And I think the important thing to understand is the longer this trend continues, where cash is doing better than shares, the more likely that shares start to become the best performing investment over the next 5 years. I think you've done the research about the best performing balanced fund over 5 years, and then looking at what it does over the next 5 years, and it's never in the tops. So I think the important thing here is don't make a change simply because markets haven't done well over time. Don't lose faith, because actually the likelihood is that the longer you remain patient, the more likely you're going to get a better return on your investment, the better the reward will be for your patience. And we haven't changed our view as a business that having exposure to shares, having exposure to the South African market with a portion of your money is a good strategy, and it will reward investors over time. History has shown that the JSE is a great place to reward investors. And don't get stuck with the mentality that the JSE is all about the South African economy. There are so many big South African businesses that are listed here that have nothing really to do with the South African economy anymore. So investors mustn't lose the focus there. But the short answer is taking the easy step now of just making a change is probably going to be a really bad idea.
Warren, let's talk about advisors and advice. We're getting lots of calls from people questioning their advisors, not our clients, it's other clients of other advisors, as to what the value of advice is. Now, if you look in this environment, what is the role of the advisor, and when are you getting good advice, and when are you just getting a broker kind of comment?
Theo, it's a brilliant question that both of us are getting all the time. I think my inbox is pretty full, and my Twitter feed is certainly overflowing with unhappy people out there. And I think what's happening here is we're seeing two things. One, a natural frustration where people are unhappy with the growth of their investments, and they're questioning everything in the investment food chain, if you will. So they're looking at the value of the advice, the value of products, the value of platforms and administration. And I think those are good questions that people should always be asking themselves. So it's natural that it's happening now where returns are so bad. I think the other thing that we're seeing is that people with bad advisors are really starting to feel that impact now, because not only are they not getting the returns, there's the likelihood that they're actually getting worse returns than even the average. And I think if you're someone sitting there watching this, wondering whether you've got a good advisor or a bad advisor, and how do you make that judgment call, I think one of the clear things will be when times are tough and you question your advisor about the returns and the advice fee that they're charging you, etc., what is the response that you get? Because if you're an investor, you should know, even before you see your advisor for your annual meeting or your 3 times a year meeting, whatever it is, you should actually know what you're paying them. You should know the percentage, possibly even the rand amount if you're looking at your statements. If you don't know what you're paying your advisor, and it's not easy and quick for you to find out, the likelihood is you've got a bad advisor. If that advisor responds badly to the question about, what am I charging you? How does it work? Then the likelihood is you've got a bad advisor. And then the third thing is, if your advisor, the moment you start to ask questions about investments and what's going on, if the first thing the advisor wants to do is just simply change all the investments that you have to make you feel happy, to put you into something that's done really well over the last 6 months or the last year, I would get up and end that relationship with that advisor immediately, because what they're trying to do is they're trying to pacify you, they're trying to make you happy today in this moment so that they can keep the relationship going with you. The likelihood is they're giving you terrible advice, because they're putting you into the stuff that's been working over the last 1 year or 3 years or 5 years, and those are the things that are most likely not going to work over the times in future. And I think at the moment a good advisor will be having hard questions and hard discussions with you around saying, if you've got the right strategy and we've prepared for bad times, Now that the bad times have arrived, why do you want to change your strategy? That's a good question that an advisor should be asking their client when they're getting a pushback from their clients. But it needs to be an open and honest conversation. And I think that's the point here, is bad advisors at the moment are just pacifying their clients. They're saying to them, when the rand's at 15 to the dollar, yes, we should just send all your money out of South Africa and sell all your investments here. And that's terrible advice. And yes, money markets have done incredibly well. So why don't we just sell out of the JSE and put all your money in a money market account? And the likelihood is, as we've mentioned before, the JSE is probably going to do much better than money markets over the next 5 years. Will it happen in 3 months or 6 months? None of us know that answer, and we're not making that prediction. And I think that's the thing here, is a good advisor now will look you in the eye and say to you, this is the right strategy for you, you're in the right funds. Yes, it's not a good time. Yes, this is an uncomfortable time. Yes, I am earning a fee when your portfolio is not going well. But the truth is, this is the time where good advisors actually earn their fees. When the markets are doing well and everything's rising, that disguises bad advice as well. And advisors don't chop and change when things are rising. Bad advisors are the ones that are now chopping and changing just to pacify their clients. So long answer, but the point here is, good advice is sometimes you need to just stay the course and stick it out. And I think we're in that environment right now.
Warren, I think what people need to realize is good advice is not what you want to hear. Good advice doesn't mean the advisor agrees with you. And perhaps sometimes the good advice is specifically when the advisor disagrees with you. But the key underlying all of this is trust. Is there a trust relationship between you and the advisor? Do you really feel and understand the issues that the investor is concerned about, what worries him? And is the investor in a position whereby he trusts your advice and he acts on that advice? Because in the end, if it's a team, it's just so much better and so much easier.